Welcome to Tim Talks Private Equity and Venture, where Tim Cunningham sits down with leading GPs and private markets professionals to explore the dynamic world of private capital. Since 2002, Tim and his team at Touchstone Group have been at the forefront of raising capital for buyout, growth, and venture funds. With decades of hands-on experience working alongside private equity and venture LPs and GPs, Tim brings deep industry insight and expertise to every conversation. Join us for candid discussions with GPs who are shaping private capital today. Now here's Tim.
Welcome, everyone. I'd like to welcome Sebastian Popik to the show. And Sebastian is an old friend. We've known each other for quite a while. We helped him raise his first fund. We're thrilled to have him. Sebastian, if you could introduce yourself, explain a little bit about Aqua Capital and kind of how you started it, when it happened, and what your vision was, I suppose you could say, behind the whole thing.
Great. Well, first, Tim, congrats on the podcast. Really looking forward to hearing your series as they evolve. And thank you very much again for the invitation. Tim and I have known each other for many, many years now. He was instrumental in us getting into business in a structured way and raising capital for us, Funds 1 and 2. I started Aqua really with a series of principles that are very dear, important to me. The concept of being a principal investor, the concept of bringing operational value add as the pillar of how value is created in private equity. And this is, 15, 16 years ago. A very strong ESG, perhaps not crystallized in those three letters, but seeing it complementary to business. And the final is invest in stuff right? So this started October 1st, 2009. You generally start off of a garage. I did. And slowly built a small team out. And we did a first club deal in a technology sector I'd worked on before. And worked out. It seemed good. And then there was quite a bit of interest at the time in Latin America. And we were able to raise a commingled fund. We warehoused the deal for that commingled fund. Always helps. And then was able to put proof to concept on these principles that I just mentioned. Anyway, the opportunity came. We raised Fund 1, then 2, then 3, which we are advanced in investing right now. Why? Well, Aqua's sector expertise is really in ag and food. The definition of ag and food private equity investment has evolved over time. I can go into that later. But that's what we know. And this comes from a family background of having an agronomist father who worked at multinationals, doing that for many, many years across Brazil, Argentina, and the US. Having a grandfather in the ag machinery business in the 50s, 60s, 70s. Both of them moved from Argentina to Brazil, and I seem to follow. So this is a sector that has been very dear. This is a sector where Latin America, South America is extremely competitive at, relevant to the world, and which I absolutely love.
Yeah. So you've lived in Brazil. You grew up in Argentina. You lived in Brazil and Argentina as a kid. And you also went to school in the U.S. Tell me a little bit about that. Tell our listeners what it was like moving from Argentina to the U.S. and how that all worked.
I was born in Argentina and at a very young age moved to Brazil. So my, let's say, elementary school was mostly here, then completed in Argentina. And then we moved to the U.S. So I did junior high and high school in St. Louis, appropriate for an agribusiness company. So I was very fortunate in many ways to get to experience different cultures in a strong family context, or for siblings. My parents, so that really pulled us together, and we had a great childhood. So we helped each other adapt.
Well, how was your English? What was that? Was that an issue going into high school directly from Brazil? That had to have been difficult. Your Portuguese was obviously pretty good, but what was the English like when you went to high school in St. Louis? My goodness.
Well, I was always told it was good until I moved to St. Louis and tried to use it. I found out that was a square minus one. There's a couple of very funny anecdotes of getting words wrong and ending up explaining them to the principal. But, I was still 12. You have this neuroplasticity still there. So you can still learn very fast. At 13-ish, that sort of evaporates. But I was fortunate to never take a language class.
Well, that's wonderful. So what was the cultural difference like? You had your family, which was an anchor and steady and consistent. But coming to high school in the U.S. at age 12, oh my gosh, lots of stuff happening in your own personal life. And what was that like?
Yeah, that's a great question. Because regardless of South America and the U.S., we'd always gone to small schools close to home. That was my parents' definition of a good school. And then in the U.S., I ended up in a public high school with 550 kids per class, right? And so on top of that, my parents were absolutely new to the land, so that the first day of school, instead of dropping me off at the junior high, which they didn't know existed, I got dropped off at the high school.
Okay.
And, I said, the girls in the movies look tall, but oh my God, they're really tall. I swam competitively. I didn't know there was a competitive team at the school. We were state champions. And my freshman year, I swam at a club. That's how lost we were. But we made it. And it was a fantastic, I think, almost American dream story, of making the best out of that, creating lifelong friends, developing leadership capabilities through student council, which was extremely valuable and delightful at the time. And actually developing a pretty good academic base. I got accepted. I only applied to Berkeley, and I got there with a full ride on my public school education. So nice. It was wonderful. Yeah.
Yeah. So take the story further. Where did you go to college then, and how did that happen?
Well, my parents really wanted me to move back. I'm the oldest of the four, so I just graduated high school, and so they said. Then they did their homework, right? They said, there's this thing called deferral. So defer for a year and try things out in Argentina. My father was being relocated back there. And I said, why not? And it ended up that I worked for 6 months because of the summer-winter schedule. No friends. But then school started, and it turned out to be a fantastic university. We were extremely fortunate to have world-class professors the world over, Argentines that had moved abroad. And we were about 80 in our class, 44 graduated.
This was in Buenos Aires.
This was in Buenos Aires. But just to give you an example of just how lucky I was with the education, the year I went to grad school, 5 of us went to Harvard to do postgraduate school.
Wow. High achieving class.
It was 2 different classes, but still that year, that vintage around produced 5 Harvard alone. So it was great.
So great educational background. So throughout all of this, how does ag fit in? I mean, your grandfather had a machinery company. Your dad was working for these big global ag companies. Lots of people whose parents or relatives are in a business don't get involved in that business necessarily, right?
Yeah. My grandfather, just for clarity, was as an executive in this ag machinery business, but he, had responsibilities. But Tim, it's strange, right? How life kind of leads you to certain places. So from a young age, we go spend Christmas and New Year's at a small town where my aunt lived and so forth. Whatever money my dad would put aside, he'd buy a farm. He started with 15 acres, an hour from Sao Paulo. And so Saturday was going to the farm. You imagine you can't plant that much in 15 acres, right? But he was practicing being an agronomist. Then in Argentina, he bought a farm a bit larger with my grandfather. So that was Saturdays as well, spending time with that. And you just naturally be there. And then my father would talk a lot at the dinner table about business. And he's always been very passionate about what he did. And I'm very proud of what he did also professionally as a person. He started from, 2 meals a day at a public university in Argentina, working since he was 18 and a half to having a great career. So I learned so much at the dinner table about ag, about business. In fact, I'm an economist. I did a master's in public policy. If you think about it, I worked at an NGO between college and grad school. If you think about it, I didn't know anything about business theoretically, but I learned it at the dinner table.
Mm. So I know just before you founded Aqua, you were working for another firm, a private equity firm. What was that experience like? How did you get involved? And I know there's a deep personal story involved with that. Tell us a little bit about how you started in this private equity arena.
I guess my career advises at some point you have to just let go, right? So structure is good, but then things sometimes work out in good ways. I was very driven and structured, but my story into private equity is definitely weird. After grad school, I went to work for a management consultancy, Booz Allen. And again, it was Brazil, Argentina, and the US. All the time, I was this repeat, story. And then it was the first internet boom. And so, I was very excited about being an entrepreneur at that age. And I launched a firm called Salutia that did healthcare process automation. And, the booms and busts and then the recovery into a business. And when I was retiring from that, passing the torch to someone else after 5 grueling years, I had 2 job offers, one from a big pharmaceutical company and one from one of my investors who had 100-year pedigree in the ag business, very experienced and knowledgeable. And I was interested in both, but I was diagnosed cancer. And the big pharmaceutical company pulled out the offer in writing. And this gentleman in his family office did not, quite the contrary. So I said, let's go with this and see where it takes me. And so 5 years later, we'd actually raised $365 million because it was a very big commodities boom. And we were in business with great LPs and the opportunity to really work in private equity.
And you'd really never been a principal investor before that?
Had not. No, I'd been an entrepreneur and I'd interacted with GPs, right? They were investors in that company. So I had half a dozen non-institutionalized investors, a couple of large family offices, but which taught me how to be like as a GP, right? I'd say, I like this is constructive, and I would never do this. So experiences, learning is both of that, and nuances in between. But I had to learn to invest. And my biggest bias, Tim, was that I was very pro-entrepreneur. I understand the pains. I understand the dreams, and I would emphasize. And at some point, the feedback I got that you get these few feedbacks in life that are really, like your neck would change 10 degrees, right? And everything you look at is different. And the feedback there is you have to emphasize less with entrepreneurs because we need to make money. So too much of a good thing is bad. That was the biggest learning as an investor. And it took me a while, quite frankly.
Yeah, it's hard to fire a friend, for example.
It's very hard to fire a friend.
Having done it, I can speak to that personally. It's one of the most difficult things. It's like checkbook discipline. It's just so hard to learn when to stop funding something, so hard to learn when to stop. And particularly because it's a reflection on your own judgment. In other words, you were the one who pulled the trigger as a principal investor on in trusting this individual and this team, and then to find that your judgment was not what it could have been, perhaps. Or perhaps the person isn't who you thought they were. All sorts of permutations, right?
Taking a step back, I love organizational ecology, organisms as living beings. And, what works in some context won't work in another, right? What worked for some time can cease to work in another. So you got a growth team and they go through a very hard time and you need a different team and it's no one's fault. Or they've become financially too secure or conservative. Or there's agenda issues that are very, very big. What's a management team's agenda? Are they 100% aligned, even if they're making money the way we do as a GP, for our LPs? Yes and no. There's no guarantee there, right? So you have agenda issues there as well. So I think that's the first thing. There's change, there's moments, there's circumstances, and there are agendas. We learn at the Harvard Kennedy School, where you stand on an issue depends on where you sit, right? But then going to your very specific point, Jack Welch would say, Most people have a 1/3 hit rate hiring very good people. Very good, recruiters, business leaders have a 50% hit rate. And he'd say, what I most do in my life is hiring people. So I think I've had a lot of expertise and so forth. My hit rate is 70%. So what he's saying is even world-class, business leaders that are great at it will get 1 out of 3 wrong.
I had my first boss and then partner in the venture business had a saying, the only mistake you can make in hiring is not firing soon enough and waiting and being afraid to pull the trigger or whatever constraint you've got. So it sounds like that might be something you learned over time too.
Yeah, you want to get it right, but I completely agree with you. If you haven't gotten it right, you're just making life worse for everyone. And you're making life worse for the other person too, because, the road to hell is full of people with good intentions. So, let's give them feedback and that. And then you also have to be very context driven. So some contexts allow more time for feedback and professional development. Private equity doesn't. It's completely unforgiving. 5 years goes by like, in a whisk of time. And so if someone is not there and been there, done that, you can always stretch someone, I think, 1 step away from the box, 1.5 steps away from the box. But if you're asking them to do something that they haven't done, have a 70% chance of doing within a year and a half, unfortunately, that doesn't work.
Right. So when you're looking at new opportunities in your pipeline, your materials say you want to identify transformational opportunities. What does that mean? How do you find those? How do you determine what was going to be transformational and what isn't?
I think there's a science and an art to everything. You want to start with the science. And so first, let me take a step back. How do I look at a business, right? The first thing is, does it have a compelling value proposition? Is it solving for a market need in a very constructive way? Is there value for different stakeholders involved? The second point is, can we work with this team or can we bring in other people that will make this a successful human being relationship, a team-to-team relationship? And the third is, how can we improve their chances to succeed? Which for us means we got to know what we're investing in, right? And sector focus really helps us there. Well, once you get there, you start developing hypotheses about what can go right and what can go wrong, right? And Blackstone would say, what do we need to believe, right? So it's like a scientific approach, right? If these hypotheses hold true for the most part and some may be non-negotiable, then this is a deal we want to make. And then you go into structuring, right? But people start with valuation many times, and I'm like, what are you buying, right? Cheap and expensive is relative. And so the transformation hypothesis come in play there, right? And can we do something significantly different that will make this business better? We differentiate between doing the basics well done, which we call growth, so commercial excellence, pricing, segmentation, go-to-market, and so forth. But when you're introducing, for instance, a completely different way of pricing, say you have a business that's selling CapEx with a very small service retainer, and you say, can we change this upside down and make this a subscription business with a long-term recurring contract? Well, that's not the basics well done, right? That's re-engineering the business. If you're going to introduce workflow technology that's going to really re-engineer the S&OP process and parts of it, well, that's not the basics well done. This is changing. You start with culture, the CapEx, the capability set. So at a modest level, it's an extension of the basics well done in a fundamental way. But then it's about R&D. Sorry, I'll go into that example. Every company should invest in R&D, and some more so than others. So basics well done is having a serious R&D program that allows us to maintain that. Well, can we transform that investment in an accretive way? Can we do, the product identification to registration process substantially shorter, even if it costs more money? And that's a smart investment, right? So we're not looking for things like we're gonna, AI transform the world, but can we find really transformational levers that will make this a substantially better business model?
Mm-hmm. So you brought up AI, big deal. Let's start with how you and your team members are applying it sort of every day in Aqua's operations. And have you done anything to use any agent related systems where there's some at least semi-autonomy going on with the use of these tools?
There's, I would say, 3 layers of transformation that are interconnected, right? The first is how we manage the firm. The second is how we manage portfolio companies. And the third would be how people think, which is obviously everything is intertwined, but let's think about it in those 3 buckets. The first thing is the last. You got to make sure that people are thinking differently, that they are understanding what AI can do and how that evolves over time. The use of AI proxies in different types of roles to help think better, organize better, filter quicker. So that's my biggest challenge across the board. And so today was my AI self-learning session. So I spent 3 hours a week in structured learning settings with my AI because I got to get the alphabet right. And the alphabet is changing all the time. So it's like W3, A4, B4. So I think that's the first thing. And as leaders, we have to understand, embrace, expose our vulnerabilities, but then move on with it. It's not going to wait for us. Now, when you talk about Aqua as an organization and portfolio companies, by far the biggest leverage is portfolio companies, right? Because if they do well, they deliver value. Ultimately we do that. And we're not that big of an organization. We have 50 people. So can we underwrite better? Yes. Can we screen better sourcing? Yes. Are we writing reports with research assisted by AI, quicker, more decentralized? Definitely, right? We're going to go into operations soon. But the real elephant in the room is portfolio company value creation. What I try to do is say, okay, where's the one thing that is across the board transformational from an AI perspective?
For a specific company or across the portfolio?
Across the board.
Okay.
And at the end of the day, we're in the growth business. So it's commercial excellence. Commercial excellence can be defined as, several boxes. So 1 is value prop. 2 is segmentation. 3 is, pricing. 4th is go-to-market strategy. So channel, market, geography, type of partners and commercial arrangements. And you go on, right? Then commercial routine, having the right one to make sure it gets done and so on and so forth. That's across the board. And then you're going to say, okay, how can we enable portfolio companies in this regard? It's not back office. It's not process automation in the back. Because 30 people, churning accounts, and you take that to 12, it's savings, but that's not where the, value is. The value is a customer will send a request for a quote and a salesperson will take 15 to 20 minutes to fill it out. But then go deeper. They'll take 2.5 days on average to sit down because they're doing field work and fill it out. So it's not the 20 minutes, it's the 2.5 days. If you can return that budget in 15 to 20 minutes, your conversion rate will increase. If you can add layers of information saying, how can I price bundle this better? How can I don't have all items on stock. Can I propose sending 72% right away while I have one more week to fulfill the rest? So that's what changes that. If you end up having 12 people instead of 30, for me, that's icing on the cake. I apologize for the job situation that creates. And it may sound inhuman, but or not considerate, but that's a whole different discussion. So if we can become commercially better across the board, we're really transforming value creation there.
So do you have specific examples where this is working in action right now? And have you got measurable results?
We're through the early innings of testing that out. What we've done is to provide technical salespeople with the entire base of knowledge so they can have this available and prescribe, say, to farmers many times in a more intelligent way. That package that maximizes farmer ROI and is also good for us, meaning we have it in stock or we have a good ROI on that product or we can bundle more. So that's the first step. Green shoots coming up, but there's still a long way to go for us.
Right. But you've begun implementing. Now, is that across the portfolio? You were mentioning you were looking for the applications that would work horizontally across a portfolio, but you've got so many different subsectors involved.
To drive cultural change and go back to the very first thing, right? I mean, executives are extremely busy. Say right now, we've gone through 2.5 years of very difficult macroeconomic patch and a very difficult 2.5 years in agribusiness, coincidentally. So people are very busy. Brazil's paying 15% interest rates, which is 11 or 10% after inflation. That's really high. And spreads are very high too. So when you talk about AI, many executives are going to say, not now, right? So you need to be very pragmatic and do simple, bottoms up, quick projects that have nice ROI. And they took literally 2 to 3 weeks. By far not the optimal ones, but they're the ones that enthuse people. ESG was the same thing, right? We had to do that and show that companies make more money, and then you have your cultural change there.
Yeah. No, it's going to come down to the people. No question at all. Yeah. So changing gears a little bit, LATAM has always been kind of a problematic area for institutional investors in the US and Europe, where much of the institutional capital is. You look at the GCC and Australia and Asia and so forth. But speaking of the US and Europe specifically, I understand why LATAM for ag, clearly, and you might give a little bit of a summary or précis of that for our listeners. But is it likely to change, that LATAM will become more attractive, less attractive? It seems to wax and wane. You had mentioned there's been some commodity related booms. The post financial crisis, people really looked to Brazil. It was late 2009. Things started to really zoom up. 2010, it was great, and wonderful, and popular, and then things sort of waned again. And this is a cycle that's happened several times. And maybe that has a lot to do with the percent of institutions that will invest. But how do you see this whole future for LATAM privates?
Well, first, I'll start from the end. I think you can, create returns in many different settings. You have to have the right strategy and capabilities aligned to that, right? So when we talk about LATAM, I wouldn't create a one rule, for all approach to that. But look, I think let's take the two major drivers of impact within, these economies. The first is the commodity cycle, and the second is the political cycle. And we are talking about the first, a commodity-driven economy. 60% of the exports come from oil and gas, minerals, and agribusiness products. 60%. And that's not such a change. And when that cycle is going, adversely, that's going to have a big impact on economies. And it's going positively, the opposite is going to happen. Now, that's not too different from other countries that have a similar matrix and large populations, I would say, but, nonetheless, it describes a reality. The second aspect is economic policy. And here I don't want to signal that the right or the left or whatever, even those lines I think are confused. But I would say, if you look at a, matrix, I would say, is it institutional government or is it populist government? Is it fiscally responsible or irresponsible? Because the latitude for being fiscally irresponsible in emerging markets is very low. Markets are very unforgiving. Capital flies very quickly. Now, when you have institutionalist, fiscally prudent governments, economies respond extremely well. When you have institutionally strong, fiscally profligate governments, you're starting to create a hole for yourself. So those are the two macro drivers, right? Now, can we predict commodity cycles and politics? We cannot, right? So we have to have robust strategies that navigate across both while keeping that macro perspective, that cycle perspective. And so distress turnaround is going to be always a feature of any economy. Okay. But here's that's not exciting. Okay. Private debt is pretty exciting as well because it's a very inefficient value chain otherwise. And banks are getting competition from different types of players, just like they are in the US and Europe. And that's promising. Okay. In terms of private equity, growth has been the start. And that's companies that navigate structural, global, systemic trends, right? That are going to help you grow anywhere. Now, instead, perhaps you're growing 40% a year, you're going to go 32% a year. That's pretty good. And so that has to do both with the evolution of the economy and demand, but also with the resourcefulness and capabilities of the local entrepreneurial community. And there's a great entrepreneurial community here seeking those opportunities, educated and so forth. What hasn't worked? Buy and build, which is weird. It's private equity 101. What hasn't worked? Because we've had a very adverse 10 years. And I can go into details to why not. So there are strategies is that a rule? No, it's not. If you're very prudent in your leverage levels, if you're very fine-tuned about the post-margin integration, if you don't build platforms that are too big, this can be a pretty good strategy. It wasn't the playbook that we were, championing in 2014 through 2020. And it even looked good for quite a bit of time. But then those rules of the economy conspired against it. So there are opportunities. There are lots of opportunities. There are natural resource opportunities as well.
So you alluded to the fact that it's not a monolithic block. That's certainly true. I mean, it's hard to compare Bolivia with Chile, for example. How do you think about the opportunity set? Brazil is a universe unto itself in many ways, not just linguistically, but culturally and size and population and the economy and all of that. There are opportunities elsewhere. I know you've moved into North America a bit with some of your latest investments. You've also moved into permanent crops as opposed to just being a value chain buyout investor. So has your geographic focus expanded beyond Brazil? It obviously has to the U.S. What about Chile, Colombia, Peru? Those are three countries in permanent crops anyway that are pretty darn strong. What's your view geographically at this point?
The expansion to North America is driven by two reasons, ultimately. The first is what we're doing in Latin America in ag, which is high value added inputs, retail to farmer transformation, ag tech and services is extremely relevant in the US and Canada. And what we find is that sector knowledge, operational value involvement has demand. When you're private equity, you're not competing for market share. You're trying to get one good deal done a year. And so there's a very abundant supply of that for us to be competitive there. Sector knowledge helps a lot. And because Brazil in particular is so evolved in these subsectors, our knowledge travels well. And it provides great perspective. So we're a quasi-strategic. That's as far as our private equity and growth program is concerned. The second driver is diversification. As a sector-specific fund, you should also be country-specific. And Brazil's the lion's share of agribusiness in Latin America. From the input side and the services side and the processing side at least, we needed to diversify that expansion. Both from an upside, opportunity side expansion and so forth.
And a downside protection.
And risk management. Now, the continent is extremely competitive in primary production as well, right? That's a bit tricky. You're closer to the asset. But we believe that through our permanent crop platform, we're able to diversify away both the upstream risk of producing these fruits through basically diversification with sufficient scale, but then also through vertical integration into end markets. Now, when you look at avocados or mangoes or table grapes or berries, especially, blueberries, many South American countries, Mexico, are low-cost producers globally for a significant window of time. So, we see a very interesting platform building concept. We love operating companies. That's our DNA. So, building this platform is something that we're excited about doing.
So are you going after greenfield or brownfield or combination? Or what's your growth strategy with respect to the permanent crops?
I don't want to be ironic. Greenfield is tough, right? Greenfield is tough and it's difficult to match the time requirements of alternative investments, even if you have a longer hold period, right? And the variability of results is very large. So if you get it right, that's the best bang for your buck. But so many things can go wrong. So we're looking much more at brownfield opportunities. Those are opportunities that we would say are 70% developed, right? Where there is some greenfield component to dilute costs, to diversify sources of supply and so forth. But
there's cash flow.
There's cash flow. Exactly.
That's the big deal.
Yeah. And, one thing I learned in a very costly way is biology is generally not exponential. So just by doing more and pushing more, a biological system is not going to grow exponentially, right? And so many times scaling very quickly biological operations creates very bad secondary effects. You lose productivity.
Can you give an example?
Yeah. Well, we invest in an aquaculture company in Brazil.
Aquaculture, you mean the tilapia?
Tilapia. And we scaled significantly and we verticalized production quite a bit. So instead of buying as much from third parties, the numbers on paper look very good to buy from ourselves, from producing more. Well, in that process, we internalized a lot of risk, which was diversified when we were buying a lot from the fish producing basin. And then the productivity indexes started getting diluted because of the scale effect. Scale in ag, scale in animal protein, you have to mature that. You cannot triple production very easily in these sectors. So that ended up working pretty badly for us. And we paid a big cost.
Yeah. So you're not likely to bet on exponential biological production.
Exactly. And I think biological plays, I'm not talking about biological inputs, more of a private equity type play, but anything means growing fruit, produce, animal protein or the like. Well, it's very difficult to find private equity returns, right? They're natural resource alternative investments. If you're doing low to mid-teens net returns, kudos to you. Private equity has a different risk return profile.
Well, in many ways, the cash flow characteristics of permanent crops would liken it more to a bond. If you have a good piece of land, you can screw it up, but it can be brought back into production and doing reasonably well if it's a good piece of land. So there's sort of a bottom to your risk, as there is with a bond, at least if your laws or creditor rights are in place. So it's clearly a different category from buyouts. So have you ever had a company, Warren Buffett, everybody lauds him as the greatest investor in all of this, but he doesn't ever really sell. And he's got I don't know how long they've owned Geico Insurance as the flywheel for the empire. Do you have businesses where you take a look at it and you go, boy, I wish I didn't have to sell this. Boy, I wish this would be something we could hold on to and really grow.
That's a really good question. Historically, yes, and this is where I had to erode my bias towards entrepreneurialism and company building, but taking those lenses off, yes, you see these companies with very big growth potential, very fragmented sectors, kind of a rinse and repeat approach with some transformation gets you pretty far. I confess that with the uncertainty around technology innovation, climate change, geo-macro politics, I'm starting to think, perhaps the holding period should be shorter because you know what you're getting into more and the next buyer will know what they're getting into more, right? As opposed to these long buy and holds. I think it's different in permanent crops, at least for the next decades, until energy's free. And then that will change. But I think, uncertainty calls for you to be much more tactical in deploying and getting out.
Of course, right now, because the cash cycle has been modestly broken, since interest rates went up, shorter holding periods are clearly not the rule. They're the exception. And, that impacts the entire cash cycle. So your investors don't have fresh capital for new relationships. They look at re-ups more with more jaundiced eye. They just don't have the capital. So talk to me a little about exits and kind of how you think about that. I mean, if the holding period will be shorter, how do you do that? How do you create enough added value to be interesting with enough potential to be interesting to a buyer at a price which gives you the kinds of returns your investors expect and you would like.
When you're leveraging shorter hold periods work better for that, right? Because at the end of the day,
if you can manage them, sure.
Right. And by leverage, I mean the reasonable amount of leverage for, a company. So you can see that more in North America, and, it's a playbook that's been there than that, and it continues to happen, right? Now, whether the buyer is increasingly a continuation vehicle, that's another story. But, private equity has established its capacity to have really objective arm's length relationship from selling to other funds and now selling to the other vehicles that they manage or co-manage. So when you're doing pure growth, that's a little bit tougher because you're J-curving companies, right? So if a strategic is going to look at it from an EBITDA perspective, 2 years, you're break even if you've done a good job, even if your revenue is 40% bigger, right? Because you're transforming, you're setting the basis and so forth. So it's tougher. So I think leverage, careful, well-organized in the US and Canada versus multiple in Brazil, South America. And when the multiples go up, well, they go up when markets heat up. And so we had one very unique occasion where we bought a health and wellness company that is extremely interesting, very, very successful, digital insurgent, making really good cash flows, growing a lot. And we were raising money for a minority, for a minority check to further grow the company and perhaps get our money out. But anyway, it was clearly a minority transaction. We're focused on financial investors and so forth. But it's a really hot market for that. And an advisor brought in a big food strategic global and said, you have to listen to them. I'm like, oh, this is not a controlled transaction. Otherwise, we'd bring other guys in. And so just listen to them. And they're prepared to go without exclusivity. So we heard them out, and it was extremely compelling. So we had selling control because multiples were much higher than when we came in. So do you wait and pray? No, but you have your companies ready, you're talking to the market. And I think the thing is to be less beholden to assets, to really be able to transact opportunistically at any time.
So you really have to remain at the ready, have stuff ready. I know you said at one point, and particularly in the markets you're in, when the window's open, you got to take it. And when the window's shut, you can't take it.
That's right. Look, in my experience, practically all exits, except that one and, another case or two that were normal exits. Man, you got to work it out. I mean, this is fly fishing with a small hook, looking for a big trout. And you got to reel it in with that patience and really, bring it in. It's very, you need very senior people to do that because there's the analytics, there's the legal, there's framework, there's contingencies, there's retention, but then there's the negotiation aspect of things, right? When do you pull, when you let go, and so forth. So you got to craft your exits. I mean, we've re-underwritten our business plans, helped with objective third parties, and helped explain the cases of why people should buy. We've hired headhunting firm to design the organizational integration for the day after. So the buyer would be more assured of what they were getting into. So you got to help the buyer help us.
Mm-hmm. And you have to show them how they can make money from the trade.
Exactly.
That seems to me to be the paramount thing, is show them why it's in their interest to do what you would like them to do.
Yeah, and if I may, Tim, I think that there's always this discussion between IRR and MOIC. I think there's no doubt that IRR is way more important than MOIC today, right?
Well, that's because of distributions and getting the money back quicker.
Yes, and obviously DPI today is, DPI is most important, then DPI tied with IRR, and then MOIC. But and when you have an IRR mindset rather than a MOIC, which is not what we're educated to do in emerging markets. Okay?
Right.
Because of this growth cycle, the J curve, well, then you transact easier, more frequently.
So you had somebody at the beginning of the business who I understand for health reasons is no longer involved, Jorge Ahumada. And Jorge and I had lots of interesting conversations about the IRR. He never would grant me that the implicit assumption in the calculation is that you're discounting everything back to a present value of zero. and therefore that somebody who receives the distribution is going to be able to reinvest it at the overall discount rate for your IRR. And he just held on to that like a dog with a bone. Anyway, it is a distorting kind of a measurement, but you're right, because it's a time value of money kind of a thing. You really can't use a time weighted rate of return, so you have to use the dollar weighted rate of return. So if you get money back faster, man, you are a hero.
Yeah, especially today, because I think when markets, are more stable and cash is abundant, LPs used to say the opposite, right? Don't give me money back if it's,
right,
kicking in 15% a year. That's great. You're giving me work that I'd rather not have because you're doing a good job with that asset. So things change, and GPs have to be very versatile.
You and I had breakfast with a big institutional investor in London years and years ago. And he said that his minimum was $250 million. And don't give me my money back because I have to put it out again somewhere. And we looked at each other because we're out fundraising for your fund. And it was like, oh, man, this guy has a different kind of problem. But it is a problem. And it's a problem for, smaller managers, right? I mean, these large pools of institutional capital, they need to put 100 to work in each allocation. They have limited staff. So in terms of fundraising, what do you see as the evolution of private equity fundraising for the next 5-10 years? How is this going to roll forward?
In relative terms, less to 20 commingled blind pools and more opportunity-driven situations. So this may change and go back to the traditional, let's say, model, but I don't think it will regain the status it had, the market share it had. LPs want fee compression. They want to be seated at the table and have direct exposure to certain assets. And they want to concentrate the number of relationships they have because then they can manage those relationships better and be closer to the action. Opportunity driven is the opposite, right? It's, look, we have $25 million in the fund and we'd like to do a $100 million deal. So you're going to have to rally those investors, right? That's how I got started in the business. You're raising money and investing. It's very difficult because you want to have a buyer's mindset. You want to know you can buy. And, that capacity to pull the trigger is extremely important because you need to be an owner and you need to have tremendous patience, but also, agility, at the right time to close. Now, if you're raising money on the side, that's very difficult. But I do think that the world is going to go there. More LPs are going to be open to those relations. Many LPs now respond pretty quickly. They're very quick in their yeses and nos and what they need to take this forward. They're very sensitive to deal lead time. So I think LPs will also adapt to that because they want that, more case-by-case exposure. I think managed accounts will grow as large LPs want to tailor their allocations. So it's going to become more of a hybrid workspace, investment space than it was a few years ago.
So in terms of the ways that will happen, I think we see the continuation vehicles certainly being driven by a trophy asset or two. We certainly see the co-investing, direct co-investing model working. Certainly secondaries have been large to get co-investment opportunities, but there's going to continue to be professional management, I think, in between the actual asset and the owner. Very, very few folks are equipped like Ontario teachers to have a staff of hundreds of professional investment management people who can pull the trigger on individual deals without a complete package tied up with a bow. Here it is. You want in, we'll manage it for you for X. So for your LPs, they're going to get co-investing for free. But if commingled funds become less operative and you're in a more single deal environment, then you're going to be like an independent sponsor if that's the case.
I completely think that the 220 commingled fund, perhaps lower fees and carry, will continue and will be the basis to anchor a lot of deals and to finance a GP. Quite frankly, that's how your fixed costs also get paid. So you can be more opportunistic as well. So I'm not ruling that out. I'm just saying, I don't know, if the world was 85-15 I believe it will be more, 70-30, 2/3, 1/3 over time. There's an undisputable role for boots on the ground, sector experienced, relationship prone managers that have been there, done that, and can do it again. And you think about the scale of those mega programs. Can you really be good as a GP across the board in all industry sectors and geographies? It's like the biology example I was giving. Very easy to lose the metrics. To let the expression we use here, to let the turtle escape. It moves slowly, but once it's gone, you can't find it. So I think GPs are irrevocable, indispensable part of the value chain, just in different ways.
Yeah. So right now, let's see, it's getting towards the end of winter where you are. Have you been skiing this year?
A little bit.
You ski, right? If I remember correctly.
Yeah. Well, I did a lot of kite surfing, but
okay.
In skiing, the weather was not that good. But yeah, it's been a cold winter, but little snow in the Andes.
Okay. So Bariloche, Las Leñas. You've been. Now, do you run every day? At one point, I knew you were into running, actually running and meditation. I remember you came down to breakfast one time and you just finished a half hour of meditation. You still doing that to the meditation and the running and stuff like that to stay centered?
Well, the answer is yes, in evolving ways. I know I only look 52 and a half, but I'm actually 53. And so we have to take care of our health in different ways. And some point, someone said, you got to lift weights. This is the thing. And I didn't like it, but 7 years into it, I really enjoy that.
What is that? 7 years into
going to the gym and working out.
Working out.
Lifting and so forth. That's been very positive. And then reading Peter Attia's Outlive, a fantastic book. I'm sure you've read it, Tim. There's the issue of coordination, right? And balance. So that's also a type of training you want to do. Yoga is great for that, for instance. Some weightlifting can also build that equilibrium. So yes, I work out 5 days a week, when I can 6, but it's a more versatile toolkit. So I run 2-3 times a week. And then in terms of, spiritual life or connection, I meditate, although I'm probably the world's worst meditator per minute meditated, which is when you bring presence, so I don't give up. But I have found that over time, reading philosophy has been a great gift late in life. And then also, I don't know if I call it religion, but spiritual religion. Yes, I'm converting to Judaism.
Are you?
Yes. And so I'm reading the entire Tanakh, which is 1,200 pages. And it's a wonderful book. And, that also is definitely a spiritual experience.
Well, I thought your mom was Jewish, right?
No, my dad is Jewish.
Oh, your dad was Jewish. Okay.
But my mom would take me to church every weekend.
Okay.
So, but she gave me faith. She gave me, the religion. But yeah.
Wonderful. Well, is there something important that I haven't asked you that you would like to talk about?
Well, we talked about culture when we were talking about AI and change management, and I mentioned, building sustainability. I guess as a leader of a company, as someone trying to think and understand how our sector is going to evolve, is evolving and is going to evolve, culture is extremely important. And can you have a culture of pushback, constructive pushback, thinking outside the box, incorporating technology in a way that you don't feel threatened, but you feel empowered by it? That's huge. This is what I think dedicate a lot of my time. Our framework is right people, right plans, right alignment, right governance. So you think about it, we start with people, and we're PE, we're not VC, but everything is about the people. And then people means the right people, the right culture. So I think this is very present in the mind of any leader building a business, where being busy is not an excuse not to do it, but it's definitely a challenge.
Can you influence or catalyze the culture, or is it up to the leaders on the ground to do so?
Both, right? At the end of the day, the tone the management team sets is going to drill down, to a good extent. But we also have measurement tools of organizational health that are very simple to apply. 2 books that I highly recommend are Who, the Scorecard, on how to hire on board. And the second one is the power score. We talked about it 10 years ago, and we do it systematically. So we'll run the power score. It takes literally 6 minutes from factory floor all the way up. And it's a great proxy for great place to work. It's like a 70-30, correlation with the score you're going to get with great place to work. We've done a lot of that. And you do get a lot of very valuable information by answering 6 questions. And this helps organizations understand their blind spots, their culture issues, their opportunity areas as well. So how can you work with that report card as something constructive? Now, if you've done that, 3 or 4 semesters in a row, it's a different story, but there's clearly an opportunity, and we can help management teams nail that down, how you work constructively that agenda.
So what do you think is the biggest opportunity you and Aqua are facing, and what's the biggest risk?
Transformation of ag and food systems through technology adoption and a climate lens that are both aligned with profit maximization is definitely the biggest opportunity, right? And this is doing more with less, building robust and resilient systems, but also contributing to the environmental agenda and to food security. Big issue, difficult to address. So that's a big opportunity. And there are different stakeholders, LPs of all types, that are interested in this and are interested in our geography because it's the biggest exporter in the world and it's only set to increase. The challenge are the nature and patience of private capital. So I'll take our example. We've been through a very bad vintage in Latin America. It's affected all GPs. Do you take that and you do a correlation, then it's going to go that way? Or are you open to selective thinking about deals and subsectors and opportunities and understanding that a super value dollar, a commodity cycle is a little bit above the means? You don't have to pray for that, but just if it stays there and imagine gets better, it's going to bode well also from a macroeconomic, or at least not be such headwind going forward. Mm-hmm. So it requires a lot of education. It requires open thinking. By LPs, they need to be open-minded and have a bigger Ray Dalio 25-year view of things. But they're out there, and it's a pleasure to meet them and build things together.
And the risks?
Well, the risks.
Where do you start?
Exactly. Some of them are pervasive to investments and businesses and people globally, right? So we've been talking about, the terrific transformational speed of AI and so forth, and climate as well, energy transition as well. The cost of energy is critical to everything we're talking about. There's always political risk anywhere in the world, right? And so how can you invest regardless of that? And that means you don't do a lot of investments that you would like to do, right? Or you get out of investments sooner than you would, intuitively want to get out, just because rationally it's the thing to do. Risk is also people, right? We have a good agenda intersection and alignment or not. When those misalign, you also have to work very hard. Those risks are very, very, very hurtful if they materialize. So, it's not an easy world, but I think we can still underwrite pretty well, and we can navigate through most settings. So at the end, and this is borrowing from Taleb's anti-fragility book, I really like, before, if you take a distribution curve for private equity, we should be doing 2.5 times net, right? And the distribution should be don't lose money, and sometimes we'll do 4.5 times, right? And my sense is that distribution curve is changing, which is, 80% of portfolios should be doing 1.5, 1.6, right? Some will lose money on principal, and some will get you to 2.2. But we can have 15, 20% smaller bets that can generate outsized returns and move that mean to that 2.5 times. So it's a different portfolio thinking. And then the second is really looking for undiversified correlation. That's tough, but you can do it. You can find it. There's no statistical model for lower mid-market ag, but it works. So we're excited to be here.
Yeah, no, well, you're in a clearly a critical space, and one that doesn't get enough respect, since we all have to eat every day. But this has been terrific. I really appreciate it. And maybe I can invite you back in at some point, and we'll do another one of these. The world will shift, things will change, and I'm sure you'll have interesting stuff to say when it does.
Appreciate that, Tim. It's always a pleasure to talk to you. I think of you very highly as a thought leader, very intellectually challenging person.
Well, thank you.
You'd be an extremely contrarian LP, I'm sure.
I might be, but hopefully not a pain in anybody's side or rear end. Well, Sebastian, thank you so much, and I appreciate it, and we'll talk later.
Great, Tim. Thank you very much. Take care.
Okay, bye now.
Thank you for listening. Please visit us online at touchstonegroupllc.com.